So first up, can I invite Kelly Eckhold, who's recently been appointed Chief Economist at Westpac. Prior to joining Westpac, Kelly worked at the IMF in Washington, DC for 11 years, and more recently as the Senior Financial Sector Expert. Kelly, welcome. We look forward to your talking points.
Thank you very much.
Thanks very much.
Thanks very much. There we go. Lovely. Thank you very much. Well, thank you very much for taking the time to listen to what I've got to say. I've just come back from 11 years in Washington, D.C., and in the geopolitical space, that's certainly become a topic that has really occupied a lot more time in the minds of macroeconomists and policymakers, particularly in the last, say, 5 or 6 years since the Ukraine hostilities with Russia really started to break out. So, you know what? Ooh. Big red button. Yeah, this guy. There we go. So there's increasing implications from this kind of geopolitical risk factor on the on the economy. I mean, and it comes through sort of two channels, I think. One is through kind of global trade flows, and one is through investment capital flows as well. Both of which have attracted quite a bit of interest, particularly in the last year or so, in the context of what's been going on in Russia, and also increasingly concerns about what's been going on with China and the Taiwanese situation as well. So with respect to global trade flows, the outbreak of the Ukraine war, and I guess to some extent in conjunction with the COVID shock, really exposed some of the perils of like just-in-time supply chain kind of management. This idea that you could rely on being able to get the things that you need for your production process from anywhere at the cheapest price on time, and that you would be able to send your product cheaply and efficiently to anybody in the world who would be prepared to pay the highest price. These types of management processes have become interrupted, especially with COVID, but actually also with geopolitical tensions as they've erupted. And you can see that particularly with what happened after the Russian invasion of Ukraine last year, where a number of European jurisdictions had to dramatically change who they trade with, both on the export and the import side. Germany is a very good example where they lost a whole lot of export markets in about 3 weeks and had to radically change where they source energy from over the last year. And if I'd have stood up here at this conference 2 years ago and told you that that it was possible that Germany would no longer be importing gas or coal from Russia or oil within a year, I don't think I would have been invited to this conference. I would have been the nut fringe. But that's actually ultimately what happened last year. In terms of investment flows, we kind of see this as well, and that's the kind of rising risk of sanctions, basically potentially trapping assets in different jurisdictions. The Russian war in particular, to a lesser extent, the outbreak of tensions in Ukraine back in 2016 saw increasing use of sanctions. They really came to a head last year where Russia was essentially excluded from the global financial system, which made it quite hard for investors to be able to even hold assets that they really held. There were a few banks, for example, that had to close down significant operations in Russia, or Russian banks that had to cede operations in Europe because they were basically sanctioned out of existence. So this is really influencing essentially where investors are happy to put their capital because of the risk that might change. The upshot of this for the macroeconomics is that it appears to be undermining both potential growth in the global economy and also increasing inflation pressures and inflation variability as well. In terms of the impact on potential growth, the World Bank came out with an interesting report, kind of like trying to map out the quantitative implications of these sorts of factors, and suggested that that was knocking off perhaps sort of like 0.5% or 1% or so off global potential growth. The IMF in the spring meetings a month or so ago came out with the lowest outlook for global growth that they had had in over a decade. Typically, they're reasonably optimistic, and that kind of like restraint on global trade was a key factor in undermining the growth outlook in many jurisdictions that added up to that total. So on the sort of practical implications side, what we can sort of see here is that there is growing realisation of the potentiality of the use of trade and the payment system and capital markets access as an influencing tool in the event that geopolitical tensions rise. It has been a trend that's really been exacerbated since the Ukraine sort of tension started in 2016 and ramped up last year. The chart on the left-hand side here kind of gives you a sense of the rising use of those sort of like trade restrictions around the world. It's become a factor that everybody has had to think about when managing their businesses, managing their investments. On the right-hand side, we can see that, if you look at the use of foreign exchange restrictions around the world, those kind of geopolitical, kind of like national security type issues are really rising in prominence. And for most countries that have signed up to the IMF Article 8 obligations, they've got a restricted list of reasons for why you can put on capital account restrictions, but national security is one of them. And that's increasingly what we're seeing around the world. That's influencing capital flows. So what does all this mean for New Zealand? Well, here we go. The thing about New Zealand is that we are a trade-focused country and we're heavily reliant on global capital. Trade is a key part of the economy. So all of these implications on supply chains, just-in-time management, increased cost and risk associated with being able to source inputs and sell exports matters quite a lot to us, particularly when you think that China is actually our largest trading partner, and they are also the one that's the source of some of the largest geopolitical tensions around the world right now. Global capital is really important to us as well. We've got a very large current account deficit right now. We've been running a current account deficit probably for as long as I've been alive. We have a really large net foreign liability position, which basically means that every day New Zealand is going out to the world to get some capital in the form of debt and equity from someone else so that we can maintain our standard of living. Anything that was to interrupt that flow would have implications for New Zealand businesses, the economy and the government. The upshot in terms of the macro is that we can probably expect to see people having to introduce more resiliency in their supply chains, so that'll be more expensive. It also means that you've basically got a less elastic supply curve, goods and services, which means more vulnerability of price variability in the event that demand changes as well, because the economies are just not going to be as flexible. So that's kind of higher and more variable inflation, realistically. And the sort of the capital flows matter quite a lot. I mean, we do source quite a lot of capital from everywhere in the world. Asian investors, Chinese investors, particularly important in our government bond market. And so there's potential flow-on effects there in the event that something happens to make investors less willing to be able to continue to participate in those markets on the terms, the realistically quite good terms that we've been used to. The other thing I'd like to point to is the kind of like our risk exposures here in the event of sanctions type activity. And there's kind of like a couple of factors there that Westpac has looked at in the last few years. One is, what are the risks to our export sectors associated with potentially someone like the Chinese deciding that they wanted to restrict business with us because perhaps our government had done something they didn't like. This is what has happened to Australia in the last couple of years in a couple of industries. And we can certainly see that if we look at the nature of the sorts of things that we export to China, there are some export markets that are probably quite vulnerable to that sort of risk, principally because these are export markets that are important to us, but they're also quite substitutable from the Chinese perspective. So it's easy for them to cut us from those things. And on that little arrow on the right-hand side there, you can see the low-risk ones. Things like wine and dairy, for example, are things where the Chinese might feel that would actually hurt them more than it would hurt us if they interrupted those markets. But there are some ones on the other side where actually it is quite easy for them to hurt us. I mean, their tourists can easily go and sit on the beach somewhere much nicer than New Zealand. The seafood industry, gold kiwi fruit. I mean, the Chinese are big producers of kiwi fruit themselves, so they could cut us off if they felt sufficiently motivated to do so, and that would have significant implications for those industries. But the other factor, which is a bit newer, is what would happen if tensions rose between the West and China to the extent to which the West was looking for instruments to be able to inflict pain on China in the same way that the West has looked for instruments to inflict pain on Russia in the last 18 months. That's that kind of German example about where are you going to be getting your oil and gas from, where are you going to be getting your coal from. Now, New Zealand is not a big exporter of hard commodities like that, but the one that I've got circled there is dairy, which is actually quite an interesting one, where it's certainly a big export of ours. It would hurt us quite badly if we came under pressure to be able to restrict our exports of those sort of things to China, but it would absolutely hurt the Chinese more because they can't easily substitute out of our dairy products into something else. So, I'm just pointing there to the risk there that if things got bad enough, if you started to see a blockade of Taiwan, for example, or President Xi acting on some of the intentions that he's increasingly suggested that he's thinking about in the next 5 years, all options start to come on the table. And it may be that our friends would like us to join them, not so much on the battlefield, but perhaps on the economic battlefield in terms of helping out with what could be a reasonably tense situation. And something like that would have big implications for New Zealand businesses, either directly or indirectly. So that's all I think I've got to say. I have run out of time, it says there. I'll be happy to take questions later on, I think.
Thanks, Kelly. Yes, indeed. Thank you. Thanks, Kelly. Right, next up, Dr. Sebastian Gierkark, Director, Climate and Energy Finance Group at the University of Otago, which pursues research in climate finance, sustainable investments, carbon farming and carbon and energy markets. Sebastian also has financial consulting experience, particularly in project feasibility modelling and investment management. Sebastian, over to you.
Kia ora koutou.
Timer down there.
Thank you, there's a timer. Perfect. Us academics tend to ramble sometimes, so it's quite useful. Yeah, it's called Farm Fortune, but I'm kind of trying to give a few trends that I see happening in my world as a sort of outside observer of what you guys do. And hopefully you guys will come away with some questions or thoughts at the end of it. So first slide, sustainable investing, right? That's what I teach, what I do a lot of my research in. And I think there's increasing focus by regulators and also customers on greenwashing, right? Making claims about sustainability or impact and not really fulfilling them. And that's sort of progressed recently to what I'd call impact washing, where you have, funds or banks or investments or companies claiming a positive impact on the environment or society. The way I like to think about this is you can invest in companies that so you can align with impactful companies, so investing in Tesla or other renewable energy companies and things like that. Or you can invest directly in projects and make something additional, something new happen, which would be impact generating, right? So that's how I kind of split the two to help with that. There's a whole lot of new data sources, and the professor before mentioned how ESG, what is it actually measuring, right? Well, that's been a problem for a while. It's in the literature how different ESG scores show very different things. So when you're using them, you need to know what they're trying to measure, right? But there's new data sources that are a bit harder that are coming, right? So spatial analysis, that's satellites measuring things like methane emissions. So Turkmenistan, that picture on the right there with the pink clouds, had more methane emissions warming potential than the whole of the UK last year. And that was measured by satellites. You'd never know that otherwise. Also, we're seeing ChatGPT or natural language processing, which you can actually use to read documents, right? So there's people in Zurich looking at something called Climate BERT, which will read climate disclosure statements and give you a quantification of that. So there's people developing these sorts of tools. And we have new financial instruments, for example, what they call conservation bonds, or the Rhino bond, right? These have real impact. There'll be partnerships of government, maybe the World Bank, impact investors and traditional investors, right? And then having revenue shares. Anyway, just touching on these topics briefly. I wanted to also talk about carbon markets, okay? Because I think there's a lot happening there in New Zealand at the moment, and it's a hot topic, and it's important to understand. So in its essence, a carbon market should be a cap and trade market. So in that grey picture, you see the red line, that's the cap of emissions. And if you're a company that emits more than that, you have to go buy credits. If you're a company that emits less than your cap, then you can sell your credits on. In New Zealand, we have this peculiar setting where you can also plant pine trees or other forests and earn credits and sell them into the market. That is unique to New Zealand and California. No other ETS does that, right? And recently, we've seen a huge increase. The green and orange sort of line area there is the registrations of lands into the emissions trading scheme. So over the last year, we've seen an increase of 33%, which, of the total, so 170,000 hectares. Before that, it was at about 400,000, I think. And, I believe that may be caused by last year, there was a suggestion to ban pine trees from the permanent forest category, which is coming out soon. And so, you get a lot of registrations coming through before the ban comes, right? Then that was put on hold. Then also we saw the Climate Change Commission recommend that the cost containment reserve, the price ceiling, be lifted, right? And so at first that was good for the price, so that's the red line there. And then that was ignored by government. They took the extra volume suggestion, right? They're going to sell more units, but they didn't lift the price ceiling, right? So the market is very constrained. Although it used to be a lot more constrained, so I guess it's better than where we were. You used to be able to buy as many credits as you like for $25. Before that, you could buy credits from Eastern Europe for $1 a pop. And so there's been improvements, but I think recently we've gone in the wrong direction. If, as the government says in their emissions reduction plan, the ETS price increasing is a core part of that. Well, their decisions lately have led to the opposite. And lastly, I wanted to touch on agriculture. New Zealand's greenhouse gas emissions are up 21% since 1990. If you look at a per capita basis, New Zealand has the most cumulative emissions in the whole world, okay, per person. All right, we're lucky because we're a big country with not so many people. But if we put that into perspective, and 50% of our emissions do come from agriculture, right? So that's the methane, the nitrous oxide, but also CO2 emissions. It's not our only issue, but it's definitely something we should be working on. And on top of just the emissions problem, our agricultural sort of intensification over the last 30 years has led to 80% of our fresh water not longer being potable. And another sort of fact to describe this transition is that urea use, so that's the fertilizer from animal urine, has increased 14 times since the year 2000. Right? So we're intensifying and we're having emissions impacts, but also much broader impacts, right, that we need to be thinking about. Now, this is an investment conference, right? So why am I just talking about, the environment and the impacts of that? Well, this creates risks for us, right? We have increasing regulations and emissions pricing coming. It is going to come. The people want it. The government will eventually have to cater to that, at least to some degree. If we take the IPCC predictions around climate change, we will have more droughts and more floods. And I mean, you're in Auckland, you're probably feeling some of that at the moment. And that's going to make the winter and summer feeding for our animals even harder, which is already a problem. Our soil health is eroding through the extreme use of fertilizer. And, we will have biodiversity loss, right? And all of this, all of our farming, everything depends on these natural cycles. We can only intensify and add inputs for a certain amount of time. So what's the opportunity? Well, consumers and investors, retail investors specifically, want this. Oh, I'm out of time apparently. I'll just quickly finish off. There's a price premium that's been found for products that come from more sustainable farming, especially in Europe, but also the US, one of our biggest customers, Nestle, etc. We are seen as a world leader, but we can fall behind if we continue on our current path, right? And there's some solutions that I put there, but we'll leave it there. Feel free to ask some questions. Sorry for being a little bit over.
Let's grab a seat. Thank you. Thanks, Sebastian. You will pick up on those points in the Q&A. And our final panelist, Dr. Jacqueline Rowath, adjunct professor at Lincoln University, as well as being a director of Dairy NZ and Ravensdown Group. Jacqueline's frequent contributor to the public debate, particularly in the media, about food production. Worked in research, education, and management, and also held government-appointed governance roles. Jacqueline, your thoughts?
Thank you very much, Andrew. A great pleasure to be here, of course. And we will get rid of, my narrative, as frankly a data-driven person, but I try to do the narrative stuff as well, is that food is a sought-after product, and governments globally are stuffing it up with their version of ESG, and I can't do better than echo what we've already heard from New York about ESG and the concept that is held there. We've seen globally the food price inflation. This is based on an index, which is actually usually more comprehensible. This is the global FAO index, more comprehensible than a percentage. We've seen the percentage misunderstandings for what's happening in New Zealand, but there is no doubt that price has gone up recently. Actually, only in the last 14 months has it exceeded wage increase, according to the Reserve Bank. But people forget that because every time you go into the supermarket, it's gone up. Yeah, you can't tell because of lost leaders. But that's a supermarket, special thing they do. So we can see that ideology is exacerbating the problem overall. Not just Russia and Ukraine, which disrupted the fertilizer inputs and, of course, harvests around the world, but also the EU with its farm-to-fork strategy, whereby 25% of land has to go into organics, and I remind you that organics is usually associated with a 40% decrease in food availability. They're also trying to cut agri-chemicals, which echoes the organic push. The Netherlands is buying farmers out of land. They're trying to take 35% of farmers, give them money to stop farming, which will, of course, remembering that the Netherlands is a very big exporter of food globally, but mostly in the Northern Hemisphere, will take them out of production, and that's to reduce greenhouse gases and nitrogen loss to the waterways. Sri Lanka, I came back from there. I was there for a week. I have been back for 3 days. Bit of jet lag still. Back for a week. What I was looking at was the aftermath of the organics, and in combination with the lack of tourism during COVID crashed the economy, and the implications of what has happened to the size of the animals that was born and the now animals that were there, they couldn't feed them. So I've never seen so many skinny cows in my entire life, and they're milking them. And then in New Zealand, we've been planting pine trees, and Sebastian has already mentioned that we're one of the few countries in the world that allows offsets. California does about 10%. There's some interesting Kazakhstan, somewhere like that, that does 100% offsets. New Zealand allows 100% offsets. So when we look at land in New Zealand, remembering, of course, that Mark Twain said buy it because they're not making it anymore, what we have as agricultural scientists, and I'm a soil scientist particularly, is we've been amending the land with fertilizer, with cultivation or drainage, with irrigation, with breeding animals specifically for a purpose to improve efficiencies all the time. But land value is driven by here, by the CBD and what people are prepared to pay for something to build on or live here with their businesses, which pushes urban, which pushes market gardens, which then push dairy, which then push deer and beef and sheep. And oh dear, beef and sheep is being met by pine trees coming the other way. So there are all sorts of squeezings of land going on, and the result is an increase in food prices globally. And yes, there are theories, and Sebastian mentioned some of them, and honestly, Sebastian, we can get into a big discussion about regenerative and what it will actually do to food prices, and the answer is they will go up. In New Zealand, we have some of the best soils in the world. So I know the regenerative people are saying, oh, it's all terrible. Actually, all our measurements are that we have wonderful soil. We have 3 times as much organic matter as Australia, but moving on from then, because they've got deserts, twice as much as America. And regenerative is a great concept for cropping and for dust bowls. But in New Zealand, where we have pasture, we've already done what is being suggested, because they're suggesting bringing in animals and putting in a bit of permanence. So there are some figures: 38% decrease in production, this is for beef and sheep, 55% decrease in EBITDA, 24% increase per kilo of product in greenhouse gases. And remember, all our clients want an environmentally sustainable, whatever they think that means, bite. They're not worried about the per hectare issue. If they're prepared to pay for a premium, it's for the mouthful that's produced sustainably. Everybody happy about that? So that's what Nestlé is going for, and Nestlé came with Fonterra and said, well, we can try it, but gosh, you're doing pretty well already. We hold the record for fewest greenhouse gases per bite, both in meat and in milk globally. Then we have the whole vat fermentation. Oh, I love that one too. Recent research, if you do your calculations from birth to death, cradle to grave, and include the proper refinement that's going to keep people safe, because what they want is safe food, and that's number one, by the way, safe food and tasty. Food Information Council gave a report yesterday that said environmental sustainability and requirement has actually gone down. Vat fermentation up to 25 times worse for the climate than meat produced naturally. And then there's the plant-based, and 23% more food. This is the American calculation. If you take away animals completely, you can get more food, but actually people aren't as well nourished. So by the time you take all the additives and supplements that you need, you're worse for the environment. By the way, any vegans here? Sorry, but don't answer this, because your greenhouse gases are worse through the sewage system. Sorry. And that's the problem with vegans. I'm not vegan. I am vegetarian. And we're going forwards. I leave you with Mark Twain. They're not making it anymore, but watch out for your investment, because land that can produce food, and that means having water and the right nutrient status, particularly animal protein that gives you all the nutrients you need for fewest greenhouse gases, remains a good investment. It's flashing. Thank you.
Excellent. Actually, I wonder, Jacqueline, if I should have Kelly between you and Sebastian.
No, he's taller than me.
But I know you'll behave there at the end there. We're going to get into a discussion now for about 20 minutes. We could pick any one of these topics, as you well know, and spend the whole day on them. So a real challenge to try and get it into 20 or 25 minutes. Please jump onto Slido. There are quite a few questions there already. We're going to try and take as many as we can. Upweight questions that you like with the thumbs up there so that we know the mood of the room, where we're going. Kelly, I'm going to kick off with you. Geopolitical risks. We barely have to open the page each morning of the papers and see how much is going on in the world. I wondered how, two-part question, strategies investors can use to manage these risks. And also, how much of this do you think is actually priced into markets at the moment?
Yeah, I mean, those are good questions. I mean, the first one, I think the key really there is diversification. From a business perspective, what this has really shown people is that they really need to have a close look at their supply chains and look at building in resilience, as well as just thinking about cost. And that's a function of looking at where you get your things from that you need, and who you sell to. In terms of New Zealand, probably we've got a pretty high reliance on China at the moment already anyway, which even without geopolitical issues would still be a risk to manage. In 20 years, the Indian economy will have a bigger population than China by quite some way, and that's a jurisdiction that we don't currently do a lot of trade with. We should probably do more with. Working on a free trade agreement at the moment, probably a useful priority, I think.
In fact, I think they've made the assessment, hasn't it, that India's population exceeds China sometime this year.
I believe it's this year, yeah.
So it's already happening as we speak. What about pricing into markets at the moment? That interests me. How much of this is actually how much are markets taking aware and are cognizant of this in terms of a pricing perspective?
I think there's increasing awareness, but I don't think you see very much in the prices yet, unless it's something where the issue is currently very live. So some of the kind of like emerging market bond spreads, for example, where a country was reliant on, for example, Russia for something, either exporting something or getting something, remittances, that's an issue. Australia has had some issues with some of its hard commodities, which have been subject to sanctions. Computer chips globally are also another one of those things where the Americans have restricted Chinese access, and that's had an implication on production as well as price. But down in our space, this is like further out in the tail than that. So I don't know that this is something that's gotten great awareness. Government's done quite a good job at the moment of trying to tread the middle line to say we're not taking sides, we want to be friends with everyone. But the question is that really going to be sustainable? Because that was what Germany was trying up until about 18 months ago with Russia.
And do you sense, particularly from your time at the IMF, I mean, these tensions are rising, aren't they? I mean, this temperature is going up.
The temperature's going up, but what has really changed is the willingness to take measures that you would never have thought would be feasible in response to those measures. So the breadth of the financial sanctions that the Europeans, for example, took against Russia last year were quite eye-opening. Cutting a country off from the SWIFT payment system, for example, was core to your ability to be able to do business outside of your jurisdiction. We were asked to sort of think about that in the lead up to the period, but we thought that would be a step too far, but that proved to be not correct. And the scale of the adjustment in oil and gas importation into Europe is quite staggering, for example. That hurt those countries a lot, but they did it anyway.
Thanks for that. We'll come back to that. Seb, question for you. Is there a carbon market model that you think would deliver better environmental and economic outcomes than New Zealand currently has, and what enhancements would you recommend? And you've only got 3 minutes on that very chunky question.
Yeah, I guess I think the emissions trading scheme and the carbon markets, the concept, as I sort of showed in that first picture, makes a lot of sense for letting price signals drive actions in the marginally most efficient way. The issue we have in New Zealand is that we've allowed forestry in, right? And so there's too much sequestration credits being given at a cheap rate because it's not that expensive to plant pine trees and leave them be. It's cheaper than planting them for timber, actually. You've got an over-allocation in the industrial allocation mechanism, so the government's actually giving most of the credits away for free. And you've got this price ceiling, right? So I think the market mechanism could work really well if it was a true cap-and-trade system, where you had supply and demand acting to create the price, and that supply was limited and aligned to our national determined contributions to the Paris Agreement, for example, right? But currently, supply is going AWOL, right? We're increasing supply in various ways that I've mentioned, while demand will be similar or decrease if the government's currently looking at a bill which will actually increase the industrial allocation rather than decrease.
So does the emissions trading scheme result in a decrease in agriculture and horticulture in New Zealand, essentially?
As it currently stands, I believe so.
Yeah, it is.
Yeah.
Absolutely. Agriculture in particular. So they have been planting areas. We saw Gisborne example, Hawke's Bay, and it then affects other parts of their industry. For instance, 6,000 calves used to go to the Hawke's Bay every year for rearing, and then they'd go for beef or come back for dairy, and that's from the Waikato, and last year it was 2,000, because 4,000 are no longer able to be housed, homed, grazed because of forestry. So there are repercussions all the way through the industry. We now have more calves, and you know the issues with bobby calves, so,
Seb, I guess this is a question that probably applies across the board. You know, in this current, tightening economic environment, household budgets under pressure and inflation and so forth, do you think people are starting to wane a bit on the climate change issue? I mean, they understand it philosophically, but when push comes to shove and it affects their budget, is that going to be an impediment to continuing to move forward in this debate?
Probably, right? I mean, if you can't feed your family for the next year, it's hard to think about the next 100 years, right? But that's why we have large investment institutions that are managing our retirement funds. We have governments. We have these entities that are meant to look at the long term sort of on our behalf as our agents and representatives, right? So that's why I think regulation is an important part of this, and also, transparency. So for investment managers and advisors, when you are offering a product that's, going to have a financial return, but you're also saying it's going to have these positive impacts or be, sustainable, or only invest in sustainable companies, then you've got to make sure you actually do that, right? It's not about the demand. I mean, if we look at the surveys over the last few years, something like 70 or 80% of retail investors want this. A slightly smaller proportion is willing to give up some return for it, right? But whether that needs to happen is another question. Yeah.
Jacqueline, your thoughts?
That people are now more concerned, in fact, they've always been more concerned about their individual wallet than sustainability. And environmental sustainability in the IFIC report that came out yesterday, International Food Information Council, 30,000 people they're looking at in 30 different countries, it's gone down. The concern about the environment has gone down. I'm not saying that's a good thing in any way. What I am saying is that because protein is becoming the issue, not carbohydrates, which is what I grew up with in the 60s, but protein, essential amino acids that are provided really just through animal protein for efficient human physiology, is becoming more important, and New Zealand has the lowest impact in that animal protein, dairy and meat. So it's, for New Zealand farmers, this should be good news. But if we have ESG over the top of it, we get in a bit of a confusion. And it's not what consumers are prepared to pay for. So although there's theories about the premium and companies saying we will, speaking as a farmer, we have yet to see it.
Kelly?
I wonder if I can jump in here as well, because I've got some colleagues working on similar issues, and they're concerned about the implied cost for food and actually food security. So because there's quite important distributional impacts of these policies.
Huge.
I mean, maybe everyone sitting here can afford to go and buy the expensive oat milk at the store, but there's some people that don't have enough income to put tucker on the table. But so on the one hand, we have policies that are basically trying to do good things for the crop, but what about the impact of it for those who can't really afford to pay for it, basically?
I want you to look at the ingredients in oat milk or any of the other things and check the amount of calcium phosphate and calcium carbonate that is used to make it white, which is chalk, by the way, calcium carbonate, and emulsifiers to maintain that chalk or calcium phosphate in suspension. Seriously? If there's any protein in it, it's because it's been added from somewhere else.
There's quite a bit of virtue signalling in this.
It's hugely virtue signalling. And fine if you like it and you're getting your protein and calcium from some other absorbable place. Most of this is about variety, and we get choices in New Zealand if we're prepared to pay. Check the price as well.
Sebastian, Jacqueline, I'm going to ask you to switch hats. Imagine you're sitting out there in that side of the audience as an investment professional. With the knowledge that you have in your respective areas, where are the investment opportunities as you see them? Sebastian?
Well, as I said on my slide, and I'm sure we can discuss this further, I think regenerative agriculture is, it is a coming thing, and there's one of the issues around that is there's loose definitions of what that actually means, right? So the way that I've been taught to understand it by a professor of agriculture at Otago is that it's working with the natural cycles rather than against it. So things like a low input, which can actually lower costs, right? I had it here. I should write this down.
Right, is this Frank Griffin?
Yes, Frank
Yes,
Griffin.
good immuno person, animal health. But moving on, I'm a soil scientist. Let me help.
All right, yeah, I'll come to you in a minute, Jacqueline. Sebastian, you want to finish your point? You find your point there?
Farm diversity, right? Not relying on a single monocrop or a single type of animal on your farm. When I teach Finance 101 at Otago, one of the main things I say is diversify your portfolio. Why are we not diversifying farms, just from a purely conceptual point of view? But there's benefits to that. Soil health, which I'm sure other people are passionate about and is very important because that's the real asset of the land going forward. And a whole systems approach. That's the key to regenerative agriculture. I said diversifying farms is another one. It doesn't have to be regenerative, but diversifying is sort of one step in the right direction. So these forward-thinking farms and agricultural companies, I guess we have now as well, would be better investments maybe than your more traditional farms as we sort of take advantage of New Zealand being seen as a leader and continue to be a leader rather than falling behind.
All right, Jacqueline, is regenerative agriculture everything that it's made out to be, and is it scalable?
Everything that Sebastian has said applies to big monocropping farms, Canada, America, Australia. Absolutely right. We don't do monocropping. You look at, it's all right, it wasn't his knee. It was the arm of the chair. Everything that we are doing on the Canterbury Plains, for instance, where we have cropping, or in Wairarapa or Manawatu Rangatiki area, we have animals coming in at certain times of the year over winter. So if I think of a particular type of farm, there might be the odd dairy farm that does little else. An awful lot of beef and sheep do have forestry where it makes sense, or plantings where it makes sense. They have a lot of manuka, and that's crashed. So there are very few farms that have only one source of income. And when we consider the dairy farms, they often have dry stock there as well, because they have some bulls, they've kept a few, whatever, and they're grazing up there. So absolutely right for Canada, America, and the Ukraine. The Ukraine has, monocropping. They are responsible, we've seen it, for the 30% of the wheat traded in the world, and barley. Their average harvest 3 tons per hectare. That's actually the global average. We hold the record, except we just lost it, at just over 17 tonnes per hectare. We are fantastic, and that's not a monocropping farm, it's a rotation farm. So agree with you, but in New Zealand, we're already ahead of the game. And one of the early adopters of regenerative, Atkins Ranch, 50% of their farms failed the accreditation this year because part of the accreditation is continuous improvement. And if you've already got a gold star, it's quite difficult to get a gold double star. And then you go to drought and you lost it. So that becomes the problem. And I think we actually have the most, in fact, we know we have because we've got the data, the most productivity gaining farmers in the world. You look at until last year with COVID, productivity gains are usually over 3%, beaten only by retail, which is spending money that's come into the country. The EU was at 1%, and my home country was at 0%. We don't have subsidies. Farmers are market-driven. If they could work out what regenerative would actually mean for the farms where we've got so much organic matter already, it's very difficult to build it up because you build up the soil bugs at the same time, and they're destroying it for their own multiplication just as fast as you're building it up. It's called a dynamic equilibrium, and New Zealand is fantastic. Our farmers have done a superb job.
Final question, we're only about 4 minutes left. So just focusing on, I guess dairy, which obviously is our biggest export and our biggest market, each with your perspective on will we still be effectively farming New Zealand in the way that we are in another 10 years? And how much, Kelly, can you focus a little bit on the risks as you see it, given everything that's coming down the pipeline in terms of climate change and sustainability issues and greenhouse gas emissions and so forth? I mean, how much of a challenge is this going to be to continue to do things the way that we've done them in the past?
Well, I mean, there is going to be this pressure for continuous improvement on the greenhouse gas path, simply because there seems to be an increased willingness for our trading partners to use this as a reason to put in place trade restrictions if they believe that you're not doing the right thing. You know, even if you are doing the right thing, if they say that you're not, it becomes a good excuse for example, an American kind of like farm lobby to go to Congress and say, well, you know, we're not having a free trade agreement with those dirty guys. You know, so that's something that absolutely matters in terms of like our marketability, basically, with our trading partners.
That's a vulnerability, obviously.
Absolutely, yeah. You know, from a diversification perspective, I mean, we need to find somewhere to sell our dairy in the event that we are not selling it to China. And, you know, when I ask my agricultural economist, well, what are the options? He says there are no options because it's just such a... We're a big part of the market and they're a big part of the other side of the market. Until you get in India or someone like that who's going to be in a position to take relatively more of that stuff, it'll continue to be a vulnerability. And that's an industry where the supply comes every day, even if the demand is not there. You know, like, so that's one where the prices can move quite a lot, and we've seen that various crises last 30 years.
Okay. Are you worried?
Oh, I think we've got a difficult balancing act to follow, because if you just focus on that China risk, it looks like it's in the kind of 5 to 10 year horizon, not the 50-year horizon. So, you know, I think we need to think about that.
Sebastian?
Yeah, I guess on the point around the emissions, I think you either get a carbon tariff if you're not doing what the EU wants you to do, or you might get people stepping away from purchasing your products. You know, I did want to touch on something. You know, we are viewed as a leader in this space in the US and things at this time, but they also think that we are. So these are investors from the US. I had a guy, MPI, went and did a study. I don't think it's public yet, unfortunately, but the investors view us as leading the space currently still because of the natural capital endowment we had when we first came here, right, when we first started intense agriculture. But that doesn't mean we're always going to be the leader, right? And I'm sorry, but I don't think New Zealand is the most carbon efficient producer of dairy. There's a report I found, and maybe that's where this comes from, by Ag Research, which was also funded by Dairy New Zealand, so don't need to talk about the conflicts potentially there or not. But even within that paper, when you actually read it in the limitations part, it says if we use the IPCC conversion factors, it's quite technical, sorry, rather than the New Zealand carbon indexing.
Country specific.
Yeah, rather than using the country Pacific, which the study used, then would be somewhere middle of the rung behind the US. Right? The study shows that they say that in their own limitations. So I think, you know, we're good, but we can't just pretend we're the best and we're always going to be the best.
All right, Jacqueline.
So the modification of IPCC is that various countries have used a particular model to show what they actually do, and that was what the Ag Research piece used. So I'd go for the actual, not just saying generically a developed country is this factor, because we have a particular model, but others are catching up with us, which is why the New Zealand farmer and the New Zealand industry never stops, never sleeps. And Otago and who else? Lincoln, Massey and now Auckland, they're all connected with trying to do something better and make sure that there are technologies to keep the nitrogen and phosphate and the rest of the stuff on the farm, not getting away anywhere else. And our animals have been bred for this specific purpose, as in they're wandering around grass, not in confinement or big barns like in actually intensive agriculture, because we're extensive still. They're out grazing grass. And that gives us particular challenges. Nobody else cares about nitrogen loss except Netherlands. And most people are not they're subsidising their farmers to keep producing for their domestic markets. Again, New Zealand is unique because we export most of our food. So we need to do it well.
All right, we're out of time. We could obviously continue this at some length. Thank you so much for your contributions. Do take advantage of our speakers during the morning tea breaks as well if you want to grab them, pick up on some of the additional points. So please join me in thanking Kelly, Sebastian and Jacqueline very much.
Thanks.